everybody. Welcome to your Money Map, sponsored by the Alliance for Lifetime Income. I am your host, Jean Chatzky. Very happy to have you along with us today, whether you are joining us on Facebook, whether you're joining us on LinkedIn. As always, we want this to be an interactive conversation because I know you're going to have questions for my guest today. We are going to be talking about end of the year planning, end of the year tax planning, among other things, with Ed Slott. And I'm sure he needs very little introduction, but let me tell you a little bit about him anyway. Ed is perhaps the country's most foremost expert on all things IRA. He has been named the best source for IRA advice by the Wall Street Journal. USA Today said it would be tough, that's an understatement, to find anyone who knows more about IRAs than CPA Ed Slott. He is a professional speaker, a television personality. You have probably seen him on PBS. You have seen him on this show before, and it's always a pleasure to dig into all things tax and IRA with him. Ed, welcome to the show. I'm so glad to have you back.
Thanks for having me back. It's great to be back with you.
Thank you so much. So yeah, we are heading toward the end of the year. It feels like we are just careening toward the end of the year. It feels like, maybe it's my age, but it feels like the clock has just sped up and we are going to be there before we know it. Talk to me about 2022. 2022 has been quite a volatile year in the markets. It stocks down as well as bonds down. Inflation at levels we haven't seen it in 40 years. We've had successive interest rate hikes. How are you preparing for the end of this year?
I thought you were going to say after that, I thought you were going to say for the end of the world after that, you wrap that up. How am I preparing? Well, you have to look, especially when you're talking about retirement, it's all long-term planning. There are always blips along the way. Yeah, the market goes up and down. Now it's more volatile than ever before. Now it goes up 500 and down 1,000 and up 800. So you really can't time things because it's too volatile too quickly. So you have to look at a long-term philosophy and just say, just ride it out. Probably the worst thing you can do, which I'm sure you've mentioned many times on your shows, is to cash out in a declining market, because then you get into a problem where you have less and it's not there for the correction, for it to go back, for the rebound. It will rebound, I believe, because traditionally markets have been volatile. Now, granted, not as volatile as this year, but it goes up and down, but up. Eventually, it's going to go up, and that's due really just to pure capitalism. Companies want to make money, and they will make money, and it will drive the market. It just may not be on your schedule.
Yeah, that would be convenient if we could predict it and those predictions would actually hold. I think there are a lot of people who would actually like that. If you've got end of the year tax planning questions or end of the year IRA questions, Roth questions for my guest Ed Slott, please type them in the comments. I'm happy to bring them into the conversation. Ed, I think many Americans don't realize or understand how much taxes impact retirement income. In the simplest possible terms, can you explain the cause and effect relationship between retirement income and taxes in retirement?
Well, taxes are the single biggest threat to your retirement savings. Remember, we all came from the school where you got this deal. Now it kind of looks like a deal with the devil, where you got a tax deduction up front. But as with any deal with the devil, there's a day of reckoning. And that date is when it works the other way, and you are forced to take that money out, say in your IRA or 401k, generally at age 72, and pay all the taxes due. So you're giving back all those deductions and then some, the earnings, the tax on the earnings, which, if you believe like I do, the tax rates are headed upward, could cost you a lot more, leaving you with less when you'll need it most in retirement, when the paychecks stop and you're relying on that money. Luckily, there's something in your favor right now. Right now, we have the lowest tax rates most of you have ever seen in your lifetime. And I know everybody complains about taxes. I've heard it for 40 years. Nobody likes to pay taxes. But I have to tell you, these are the good old days. There are opportunities here to take advantage of low rates. Just to give you an example of how good it is, the years people like me, the baby boomers, were born, 1946 through 1964. For every one of those years, the top federal tax rate exceeded 90, in case you didn't hear it, 90%, except for
Wow.
the last year, 1964. That's when the Beatles came to America. And
When I
everybody,
was born,
oh, yeah, 64?
64.
That was a great year. That's when the Beatles came to America, and everybody was so happy. They lowered the top federal tax rate all the way down to only 77%. And the whole country did a happy dance. Look where we are now. The top rate now isn't even half of that rate. Now, I mention the history because there's a saying, Mark Twain said, history doesn't repeat itself, but it rhymes. Or another way to say that, those who don't learn from history may be bound to repeat it. So I'm saying it's the deal of the century now. The key to saving the most money in taxes is to, and this sounds simple, but this is a fundamental principle behind all great tax planning, always pay taxes at the lowest rates. It's kind of like buy low and sell high. Now, I didn't make that one up, but write that one down too. That's a good one. Buy low, sell high.
How far do you think, if you're projecting, I mean, when you look historically at tax rates and you look at where you think tax rates are going in the future, what's your best guess?
Well, you have to look at the numbers. It's math. I look at the math. They just announced the deficit levels for the past month. I don't even remember. Now they have phone numbers, the billions or trillions. I can't even keep, I used to say it was a phone number, but now the actual digits are more than a phone number with the area code and the one. At some point, the whole country is living on a credit card. So I have to believe something's got to give. Then you have the demographics, more people like me going in and needing Medicare and Social Security. Who's going to pay for this? I got to believe tax rates will be going up. And who is going to be stuck paying the bill? The people with the most money that has not yet been taxed, like your IRAs and 401ks. They'll be left in the soup when the music stops. By the
So
way,
this is your argument for Roths.
right.
This is your argument for paying your taxes now if you're able, either by making a contribution to a Roth IRA or a Roth 401k or a Roth conversion. Who should be, I know your answer might be everyone, but who
I am a
should
big
be,
Roth fan, but nothing's
yeah, I
going.
know you are. No, but who should be and who should not be taking advantage of Roth IRAs and Roth 401ks?
All right, let's start with the easy ones. Young people. Young people entering the workforce. That's a slam dunk. That's 100%. Anybody starting to save for retirement, their 20s and 30s, their first job, whatever it is, should only be doing Roth IRAs and Roth 401ks. We didn't have that option. Could you imagine, Gene, if we had the option from dollar one to save for retirement totally tax free? All of that money would be tax free. They have that opportunity now. The greatest money making asset any individual can possess is time. And young people have more of it than anyone else. And this is their opportunity to take advantage of it. The tax deduction, if they do a 401k or an IRA, big deal, they get a tax deduction. But think about tax deductions this way. A tax deduction is really just a loan you get from the government that you have to pay back and then some. Plus, tax deductions when rates are low. I already said rates are historically low, but younger people are generally in their early years and at lower incomes. So they're really low. There's no benefit to taking a deduction that you'll pay back in your retirement. So that's a no-brainer. Younger people should all be starting off Roth.
How about for somebody closer to my age, right? I'm in my 50s. I said I was born in 1964. That makes me 58. I am probably in or around my peak earning years. I am making a contribution to a Roth 401k. Is that a mistake?
No, I still love the Roth. Again, everything I say is not for everyone, like anything. You always run it by your accountant, your tax advisor, and a Roth conversion, for example, where you actually pay to convert an IRA to a Roth. And before you do that, always run it by your tax advisor and your financial advisor, because in the last few years, this rule has changed. If you do a Roth conversion, yes, you will owe the tax, and there's no going back. There's no do-overs, no second chances. Remember those days you could go back and forth? Those days are gone. So you will owe the tax. That shouldn't deter you from converting. But back to your question on contributing, again, you're putting money into an account that will grow tax-free for the rest of your life. If you income tax free, I should say, if you believe, and again, it's just the whole Roth area is a big, giant bet. You're betting that future tax rates will be higher, which I think is the case. And I always go to the worst case scenario. What if everything I'm saying today is wrong and and tax rates don't go up? They don't do anything about the deficit, which is kind of what they've been doing for years and years.
Right, exactly.
What if I'm wrong? So whenever making any decision, especially financial decisions, you want to see what's the worst case scenario if I'm wrong. Maybe tax rates for you didn't go up. Maybe they went down. I doubt it. But if I'm wrong, here's the great part about the worst thing that happens. You've locked in a 0% income tax rate for the rest of your life and even 10 years beyond under the new Secure Act. That's not a bad consolation prize. You can't beat a 0% tax rate.
You brought up the new Secure Act. So Bruce writes, and he would like to know, what are your thoughts on the expected new Secure 2.0? How might it affect IRAs and retirement planning? And just a shout out to our other listeners. If you've got questions, feel free to type them into the chat. I'm happy to incorporate them into this conversation.
We don't really know. As of this date, it's it's anybody's guess. Now, this is what's amazing. I wrote this down. I had a feeling you'd ask about it. The Secure 2.0, and this is almost hard to believe given the polarization in Congress. The bill, one of the bills, the main bill that we calling Secure 2.0, passed through the House, 414-5. Have you ever, I talk about bipartisan. I wonder who the 5 were that don't like retirement, but so there's total bipartisan support for it. But can they get anything done? The only way I think, and I don't have any inside Washington knowledge, is that if it gets attached to something like a spending bill like they're talking about that absolutely must pass. If it doesn't get attached to that, it's not going to happen this year. And there wasn't anything that great in there. I mean, it helped if you had the ability to make more catch-up contributions, to put more money in, and they raised some of the levels. But again, it only helps people who have the money to add more money. It's great. What if you could put, I don't know, 100,000 in your IRA? You still have to have the money. So people say
Right.
that's great. There was another thing in there to raise, and Congress loves this, to raise the RMD age, required minimum distributions, which is currently 72. It was 70 and a half for many, many years. And the best thing, the Secure Act, probably the single best provision in the Secure Act, was getting rid of that half year. That was the bane of most questions. People hitting 70. Am I 70? Am I 71? When am I 70 and a half? Which chart is it? When is my birthday? When is 6 months after? They didn't know. You never have to know that ever again. Now it's 72. But there's a proposal, and what we're calling Secure 2.0 is actually a collection of, I think it's up to 3 or 4 different bills. One called the EARN Act, the RISE Act. They have all these acronym acts. And they have to reconcile all of this to one act that can get attached. So I don't know if they have the time to do that. But a common provision, I believe in all of them, is to raise the RMD age over many years to 75. Is that good? Maybe. People love it because, oh, good, I can have even more years before I don't have to take it. That's not good. Maybe it's good that you don't have to take it. But remember, under the Secure Act now, there's a finite window on when the entire account must come out. And for most people, that's going to be 10 years after death. So let's say they raise the RMD age to 80. That shortens the window that all this money has to come in. The more you bunch all of this money into a shorter tax window, the higher the tax will be, and more of it will be lost to taxes. You're probably better off taking RMDs even before you have to. The RMD, required minimum, the M stands for minimum, it doesn't stand for maximum. You can do more. You can take advantage of these big tax brackets now and get more income out. Again, my rule, paying taxes at lower rates.
I actually think there's another side to it as well, which is that we sometimes hear about people in retirement holding on to principal a little too tightly,
Right.
not feeling that they can spend this money that they have worked so hard to save because they want to leave it to their kids or because they think that they're going to live a lot longer, and they're not enjoying their retirements as much as potentially they could. I mean, that's one of the benefits to knowing that you've got some pension income or annuity income coming in.
Yeah, you're absolutely right. It's never enough. I was just talking to a client of mine, an old-time client, the daughter actually, who was pleading with me to talk to her father. He's the one that I have the relationship. He's 92 now. He has about, I don't know, 8 million in his Roth IRA or IRA combined. And I said, he's got to do something. Well, he's afraid. What if he needs the money? Like, it doesn't matter how much you have. Nobody, very few people, you're exactly right, like to let go.
Yes, exactly. When we're talking about Roth conversions, and you brought this up earlier, Ed, what would you suggest for people who are still considering converting an IRA to a Roth in 2022? Is it too late?
It's not too late, but the funds have to come out of your IRA by the end of the year. Now, what I would tell you is don't wait till on any year-end transactions, whether they're RMDs, Roth conversions. If you don't get it done, I would say by Christmas, don't even try. The people at these custodians, the mutual fund companies, the only people that really know anything there know to take the last 2 weeks of December off, and they won't be there. They just can't handle all this last minute stuff. Don't be a last minute person. If you're going to do something, get it in really now before it really hits the fan over there, because you don't know when that transaction's going to be processed or if it's going to be processed on time. But you want to look at the brackets in 22 and even 23. You talked about inflation earlier. Yes, that's a bad thing, but when it comes to taxes, it's great. The tax planning, it's great. We have had the largest increase due to inflation of the tax brackets. How much more money, even in 23, the largest in history, how much more money you can get out. This is in 23 rather than 22, in the 22% bracket, in the 24% bracket due to inflation increases. You might want to look at 2 years. You might even want to look at 4 years. 22, 23, 24, and 25, a 4-year plan. Why do I stop there? Because that brings you to the end of 2025. And I think you know what happens at the end of 25. The old rates come back unless the law changes. We revert back to the old higher rates after 2025.
In terms of the assets that you are converting to a Roth, I know it gets tricky because of what's called the pro rata rules.
Right.
Can you talk about that in the context of the fact that we've had a down year in the market, and for the purposes of converting, that's not such a bad thing?
No, for I'm glad you brought that up, because that I've been getting all the questions. Oh, the market just went down, like I was saying before, 800 points. Should I convert? I said no, because the market, by the time you get the order in, it's going to go up 1,000 points. You can't get these orders in time due to the extreme volatility. If you watch the market, it seems like every day it goes up. I said it before, it goes up, it goes down. It's almost impossible to time. The best way to time, if you really want to time the market, you have to do it over a long term, more moderate approach. Maybe use a series of monthly or annual conversions over time to bring down that IRA balance and bring up your Roth IRA balance. So you kind of dollar cost averaging into the market. So you get the highs and the lows, but it's very hard. Yes, the answer is obviously if you know the value is depressed and you have low rates, that's a double hit. But don't be surprised if, for example, it goes down tomorrow and you say, oh, now's the time. And then when the order's in, it went up again. You have to look long term. I had a client of mine, a doctor, I think back in 18, I think. She was hemming, hawing, she didn't even need her money. She was still working, making a lot of money. She wanted to do it for her grandchildren. This is before they killed the stretch IRA. Anyway, she wanted to convert $1 million from her IRA to her Roth and name her kids and grandkids beneficiary and all that. So all year, she said, should I do it? Should I? Finally, around Christmas time, she pulls the trigger and she converts it. Then I get an email the next day. I'm devastated. It happened to be the next day was the highest single day uptick. It went up 1,000 points that day, and she was beside herself. So I called her and calmed her down. I said, the same thing I'm saying here. It's a long-term thing. Now, she called me at recently, and same kind of thing. The market was down and up, and she wanted to time more of it. I said, wait a minute. Let me tell you a story about somebody like you, meaning you. In 18, when you complained and went on and on that you converted at the top of the market, I looked it up. You know what the market was when you carried on about that? 23,000. Now it's 30-something thousand. So long term, you did great. All of those gains will be tax-free forever. So you have to look long term. Very hard to time the market in anything, but especially for a Roth conversion. But if you really have a dog or something not going up for a while, maybe that's one that you can convert reliably at a low price. Look, the Roth IRA, it's no question. It's the best single account, retirement account to own. The only thing is how much are you willing to pay to get it? That's it.
We got a question from Alan. He says, my son is a recent college grad who finally got a job in his field. Unfortunately, it's freelance right now. No benefits, meaning no 401k. Should he open up his own Roth IRA for now?
Yes. I mean, you can only do it up to the amount you earn. If he doesn't earn the 6,000, let's say, for 2022. But this is where parents and grandparents can help out. They can make gifts. I did this with my older daughter many years ago when she got her first job. She worked at the library locally one summer. I think she was 15 or so, and made $350 that summer. I opened up her Roth for $350. She thought this was great. I had to explain. She said, so I work, I keep that money, you replace it, and it grows tax-free forever? She said, that's great. I said, that's the rule under this rule. For two reasons. I wanted to teach you about Roth and investing and building your own retirement account early, because we both know mathematically, the earlier you start it, the more you'll always have. But I also wanted to create the container, the facility for her, so when she's on her own, it's more likely, and she has, now she's in her 30s, but now she has continued because I set that up for her.
Well, it's the habit. I totally agree with you. Yeah. I did the same with my own kids, and it's great for them. This is how we build investors. When they see the money in their accounts growing, they start to get excited about that, and then they're willing to contribute more of their own money so that it too will grow for the future. It's how we build investors as well. A question for you. We brought up annuities before, and people often will ask, why would I buy a tax-deferred annuity in a tax-deferred account? It seems redundant. Well, can you explain the redundancy, if there is one, and what you would say to that?
All right, you threw me a softball there. That's so easy because that's the most common complaint, but that's not the reason. The reason you do the annuity, and I have them myself, because you want guaranteed income for life. There's a big deal. It's a big deal to have a guarantee, especially we're talking about all this market volatility. The last thing you need is the market to crash just when you need your money. This is guaranteed income. I'm not saying everybody should do it for everything, but that's the big benefit. It's the guaranteed income for life. The only thing better than guaranteed income for life is what I have. Now everybody's thinking, what do you have?
What do you have?
Better than guaranteed income for life with annuities is guaranteed. If you're listening, I just told you the answer, guaranteed tax-free income for life. I put these annuities in my Roth IRA. So I have the double benefit if I ever need it. And I didn't do it for everything. I just use it, the annuities, as a cushion, a guardrail, a protection against downside risk. I still have a stock portfolio in my Roth. I'm not saying do it for all, but if I had a rule, and here is my rule, for for your basic monthly living expenses, whatever that number is for you, and it's different for everybody, I believe that money has to be rock solid, guaranteed, and that's where annuities really do beautifully. The reason I did it in my Roth, if I ever needed to draw, I'm hoping not, I'm hoping I leave that to my kids. If I ever needed, first of all, in the Roth, you never have to draw that money out. That's one of the big benefits of the Roth, no required minimum distributions for the rest of your life. I would have guaranteed income and it would be tax free. So that's a great deal. So that's what I would say to people who say, well, it's redundant. Yeah, it's tax deferred when it's in the annuity. It's tax deferred in the IRA, but that's not the big point. The big point is financial security. My mother had these. She died recently, but my father died many years before that. And she had a financial advisor who realized she was like the Energizer Bunny. She was going to go a long time. In fact, even in her 90s, she was still looking for a man. She used to complain, I'm looking for a date, not a patient. Nobody could keep up with her. So he was a smart advisor, not me. I don't sell any of these products. I'm a tax advisor. And he put her in. She sold the house we grew up in. And he put her in, I think, 4 or 5 of these annuities. Best thing that ever happened to our family. Those checks came in, and this is throughout the 2008 crash and everything else that bad that happened. Those checks came in every month, no matter how old she got, no matter how sick she got, and no matter how the stock market performed. She was in heaven. Even at the end, I was in the hospital with her. I said, Ma, you only have like $600 in your check. What do I care? I get new checks every month.
I think that's why this year in particular, a lot of people are taking a look at them. But can we talk tactically for a second? And then to Mary and Ed and Sharon, I want to just tell you, I'm going to come to your questions in just a second. When we talk about an annuity in a Roth IRA, and this is the question that Ed is asking. He says, how about a Roth annuity? Is there a specific way you have to buy that annuity?
No,
Do you buy it
again, I'm not
in the IRA? Like, how does that work?
No, I'm not a product guy. I have a financial advisor, like I'm advising everybody here. Again, I do taxes. I know what I don't know, and I have a separate financial advisor, and I have money in my Roth. And I said, he suggested certain annuities. I have a few of them in there. And I use my Roth money to buy the annuities in my Roth IRA, and they sit there as part of my Roth.
Gotcha. Okay. Mary's question. Where's the best place to set up a Roth with low fees? And she also wants to know, is a Roth different than a target date retirement fund? Let me take the second part of that.
Yeah, I know.
Mary,
you can take the first part too.
So Mary, it is different. A Roth is an account. Like an IRA is an account, like a 401k is an account, like a 529 college savings plan is an account. And into that account, you put investments. A target date retirement fund might be one of those investments that you would potentially buy through your workplace 401k or your workplace Roth 401k. The best place to set up a Roth with low fees, you can look at any brokerage firm. Any of the big name discount brokerage firms is going to have a Roth with low fees. I would start there. Sharon says,
Before you start, I have another way of when people ask me that question, because they always get the two mixed up. I don't drink at all, but this is the best analogy I could come up with. The Roth IRA is the carafe, the container. The investments are the wine or whatever you put in there.
Oh, that's so much better. That's so much more fun. Sharon writes, I contributed to my Roth IRA as long as I was employed in a company job, 30 plus years. After being quote unquote early retired, I've been freelancing and able to write off many of my taxable expenses. How do I figure out what I can put into my Roth from my earnings, even though I don't make much money and don't pay much in taxes? Do I need a CPA or an accountant to look at everything?
No, I mean, right now for 2022, it's 6,000 is the overall limit. If you've made more than that, you can put in the 6,000. If you made 30,000, you can only put in 6,000. But if you only made 4,000, you can only put in 4,000.
Got it, Sharon? It's really the amount of money that you brought in that is the limiting factor in the
No, the net income. If you have a job, I'm talking about the net income. So say you
net.
brought it in 10,000, but you had 4,000 in expenses, and you would need to use, not to get in the weeds, but I kind of have to, a tax program or an account, because even in my simple example, if you gross 10,000 and you had expenses of 4 and you netted 6, you couldn't put the full 6 in because there's a little adjustment for half of self-employment tax. The computer will do all that.
And it'll tell you how much. This is
Yeah,
where QuickBooks comes in very
yeah,
handy, or
right.
Quicken, or TurboTax. We're coming down to the end of the year, and I would like to know if there are other tips that you'd recommend to people for end of year tax planning.
Well, one of my favorite ones, unfortunately, it doesn't apply to everyone, but it's qualified charitable distributions. This is the time people think about giving, and most people do give. In fact, if I had to take a poll, I would say 100% of people give to charity, because after 40 years of doing tax returns, whenever I asked a person, did you give to charity? Oh, yeah, I gave plenty. Nobody ever said no. So according to my own 40-year survey, the answer is everyone gives to charity. The difference is now most people get no tax benefit for the gifts they make to charity anymore, since that Tax Cuts and Jobs Act increased the standard deduction. 90% of the people, now it's going to be even more for next year due to the inflation increases, even in the standard deduction. I told you, inflation is good. It increases all the tax breaks too. So more people, over 90%, claim the standard deduction, and they don't itemize. And people 65 and over get actually an extra standard deduction. So it's more likely you're going to use the standard deduction, which means you don't get any itemized deduction for the gifts you're already making. If you qualify for something called a qualified charitable distribution, you can transfer directly from your IRA whatever you were going to give. I'm not saying just give more for a tax benefit. If I was saying that, just give all your money away and you'll never pay taxes. I'm talking about the giving you're already doing. Let's say you give $2,000 to the church, whatever. All right, that's what you normally do. You get no tax benefit. Instead, transfer from your IRA directly to this qualified charity, and the amount that comes out of your IRA is excluded from income. So you get better than a tax deduction. You get an exclusion from income, which lowers something called adjusted gross income, the key number on your tax return, which determines the availability of other benefits, credits, deductions. But the only downside here, it's not available to enough people, in my opinion. It's only available.
How do you qualify?
What?
How do you qualify?
It's only available to IRA owners, not 401ks, IRA owners or IRA beneficiaries who are at least 70 and a half years old. Now, earlier on here, I said the RMD age was raised to 72, but not this age. This age stayed at 70 and a half. So you have to actually be 70 and a half and have an IRA to qualify. And you have to actually be 70 and a half. In other words, if you're 70 and a half tomorrow, you don't qualify today. And you make a direct transfer. You don't touch the money. It goes right from the IRA, your IRA, to the charity. And if you're subject to RMDs, it can offset the RMD. Let's say in my simple example, your RMD was 2,000. Well, this satisfies that. You don't even have to take it. You don't have to pay the tax. Remember before I talked about getting money, the best tax planning you can do is getting money out of your IRA at the lowest rates. You're getting this money out at 0% tax rate for doing gifting you were going to do anyway. But
Right.
you have to follow the rules, and you have to be 70 and a half IRA owner and a direct transfer to the charity.
By the same token, if you are not 70 and a half, if you are younger and you would still be giving money to charity, are you better off just giving appreciated securities that you have anyway to charity?
I don't know. I have mixed thoughts on that, and that's I'll give you the pluses and minuses here. Yes, you can give appreciated securities. Let's say you bought stocks for $1,000. Now it's worth $10,000. As long as you held it more than a year, you can give the $10,000 of stock to the charity. And again, I wouldn't do this just for tax planning purposes. This is if you're already giving anyway. That's you're charitably inclined. You want to do this. I would never do things like that just for tax planning purposes. So you would get a deduction for 10,000. So that's one school of thought. The other school of thought is if you have really highly appreciated stock, and a lot of older people do, hold that if you can till death, and then nobody will ever pay the capital gains tax on it through the step up in basis. Now, if you do the charitable gift, you also get relieved of the appreciation, the gain. You don't pay tax on the gain, and you get the full deduction at 10,000. If that even helps you have enough itemized to get over the standard deduction limit, so it'd have to be a big gift. But then you're giving up the property. If you leave it to beneficiaries at death, you never give up the property, and they still don't pay the capital gains tax.
Bottom line, there's a lot to do, or at least a few things to do to check off your list before the end of the year. Anything else that you don't want us to miss?
Well, here's something. Again, I talked about doing transactions at year end, and many people got hit, as you know, I believe this week or last week, with the big sell-off of mutual funds. This happens every year. Everybody every year makes, oh, look what happened. How could I didn't have all these capital gains. And I, as a tax preparer, I see it sometimes, at the next year and they said, nope, I didn't have, no, you did. The fund company had a sell-off. And he said, but the market was down. You have more sell-offs when the market is down. So you have all these phantom capital gains, or income to you. So you may as well try and look for losses now to maybe, they call it harvesting losses, matching up losses to offset the gains. And if you're really going to be short, what you can do, you may want to look at your estimated taxes you had paid in. And if you have an RMD, an IRA distribution due before year end, for example, you can take withholding. I've had clients that did this over the years. Let's say you're short. You just didn't pay in enough estimates, and there's a penalty. You're supposed to pay as you go. But withholding doesn't work that way. You could have taken RMD, an IRA, it doesn't even have to be an RMD, an IRA distribution, say for 10,000 or whatever you think you're short, and make it all go, have the institution send it all to the government as federal withholding tax. Even if you did that on December 31st, under the withholding tax rules, that withholding is deemed to be paid in evenly throughout the year, even though you held on to all that money the whole year. And that could save you from an estimated tax penalty on some of the income, the increased income you just received if you had a big holding in mutual funds.
Ed Slott, saving us money every time we turn around. Gotta love it. Thank you so much for coming back to the show today. Thank you for all of this excellent advice. I know that our listeners and our viewers are going to want to reach out to you. What's the best place for them to do that?
Well, you can always go to our website to see what we have cooking there. And it's www, I don't know if people say that anymore, maybe because I'm old, IRA Help, IRAHELP, IRAHelp.com. And there's a lot of help, a lot of free stuff. We have a mailbag. We answer your questions, IRA questions, me and my team of IRA experts, and you get the right answer the first time. I'll tell you that. You get your questions answered. You can sign up for our blogs, all free, loaded with current information. It's a great resource, and a lot of other goodies on the site, but that's a great resource for just the kind of things we're talking about here today.
Yeah, it is a fantastic resource, and you're a fantastic resource. Thank you so much. And for all of you watching, if you'd like more information from us at the Alliance for Lifetime Income, go to our website. It's protectedincome.org. For information on this particular conversation, protectedincome.org/end of year 2022. There's some dashes in there, so I'm going to throw it up on the screen after Ed and I say goodbye. Ed, thank you.
Oh, thanks. I just end with this one thing. So you talked about income for life, like with the annuities. I have to tell you, the people that have these things, I've noticed in my career, people with guaranteed income, they're just happier people. They don't worry about anything.
It is so true. It is so true. You are preaching to the choir with me. Ed, thank you so much.
Thanks.
Bye.